Michael, thank you very much for joining us today. How are things in the great city of London?
Well, hi Jimmy, great to be here. I think they're doing pretty well. At least we're sharing in the uncertainty for once.
That is for sure. So, Samuel Johnson said, if you're tired of London, you're tired of life. And a lot has changed since he spoke these words. But what are your thoughts on London? Is it still a great city?
I think London's a great city to be in. Yeah, there's always there's a slightly chaotic edge as always, but I mean that's creative chaos. I think it's London is quite dynamic, but there's a lot of other places in the world as we know. The only problem we've got here are high tax rates, so that's a great disincentive for the young.
Well, that is one thing we share in common, but I can assure you our taxes in Canada are much higher than yours. So let's start it off. I want to begin our conversation with your recent Substack, and it was titled Capital Wars Are Here and China is the Great Disruptor. What do you mean by that?
Yeah, well, I think the sort of segue into that, Jimmy, is to say that it may well be that Trump wins the trade wars. I mean, that's clearly possible. Who knows? But he isn't necessarily going to win the capital wars. And the counterpart of a trade war is a capital war. And that ultimately, I think, is what the US and maybe what Trump really wants to win at the end of the day. The problem they got is that they kind of lost control of the US Treasury market, which is critical. And this is what the markets are kind of playing with right now. And I think if you think about this geopolitically, perhaps, I mean, China is actually holding an ace card, and that ace card is $720 billion worth of US treasuries. They're pretty unlikely to be accumulating any more. So they're a sort of an opportunistic seller. And why don't they just be mischievous and sell at the wrong time? At the wrong time for Scott Bessent, that is. And we know he's got to fund what, somewhere between $9 and $10 trillion of US debt this year, which is rolling over about 30% of the existing stock. And, there's going to be a lot of auctions, and there's also going to be a lot of potential volatility in the bond market. And if China can make that tougher, I think it may well try. So I think what we've seen in the last week may well be evidence of China mischievously selling bonds at the wrong time. The yield is backing up. And I think the sort of disquieting thing that you can see in the treasury market in the US is that even though everyone is now convinced, seemingly, that there's going to be a recession, the 10-year yield is trading above its 200-day moving average, which doesn't seem to make any sense, except for the fact that supply is in excess of demand, and that supply may be coming from the east.
So, very interesting points. Let's provide a little more context here. The US has $37 trillion in debt. The government takes in 5 trillion but spends 7 trillion, so it's running a $2 trillion deficit. Interest expenses are over $1 trillion, and they're going to continue to grow as the US government has to refinance this debt at excessively higher interest rates. And as you mentioned, they have to refinance $10 trillion of debt this year. So I just want to clarify one point. You're suggesting the Chinese are selling bonds to drive up interest rates to make things more difficult for the US.
Yeah, that I think is a pretty reasonable assumption of what's going on. I mean, otherwise, why should it be that yields are rising at a time when everyone is convinced that you've got a recession upcoming in the US? We know that bonds typically perform well. In other words, yields fall during a period when a recession is upcoming. And why shouldn't that be the case now? You'd expect that in this uncertain defensive time, the people would be essentially shuffling off towards the fixed income markets. And they don't seem to be doing that. And that is a kind of head scratching moment. The only reason I think that you can logically say is that somebody is mischievously dumping treasuries here, and that may well be the Chinese. Who knows? But never say never. And it may well be if you look at the old when I was in Salomon Brothers, there was always a saying on the trading floor, which is there's no unrelated event in financial markets. And if you look at what's happening in the last week or so, what you've seen is the treasury market selling off, yields rising, but you've seen the gold price just pumping higher all the time. Now, it may well be that China is actually shifting out of US treasuries into gold. I mean, that would kind of make sense. And one of the thoughts that we've had for the last couple of years is that actually what China is trying to do here is to devalue the yuan, but not devalue against the US dollar so much, but actually devalue against gold. Now, that may seem a sort of puzzling thought at first, But in fact, what China's got is a whopping great debt problem. And one of the ways to get out of a debt problem is to actually devalue your paper money. But what you really want to do is to devalue it against real assets, because the debt is effectively taken against the real asset. So if you devalue paper against real assets, in other words, gold is a real asset, that may be a decent proxy for real assets generally. If the gold price in yuan goes up, they're basically getting themselves out of their debt problem progressively. Now, if you go back to 2022, early 2023, the yuan gold price was 11,000 yuan, i.e. renminbi, per ounce of gold. What is it right now? It's 23,500 yuan. It's more than doubled over that space of time. And basically, why is that? It's because of a combination of two things. One is the Chinese officially and privately are buying gold bullion. And secondly, what's happening is that the PBOC, the People's Bank of China, is actually printing money again. And they've given up their policy, I think. We'll see, but they've given up their policy of trying to shadow the US dollar. And they're letting the yuan devalue as well against the US dollar, while devalue more significantly against gold bullion. Now, if you kind of work this out and you say, well, okay, how far does this go? Well, our original calculations about a year or so ago said, in order to get out of that debt problem, what you probably need is China has to devalue the yuan against gold to 26,000. So we've still got some mileage to go here, but we're in sight of that. And if you triangulate 26,000 yuan per ounce with a renminbi US dollar cross rate of about 7.35, circa where we are now, you come out with a gold price target of 3,500, 3,600. So I don't think that's fanciful at all. I mean, we're getting pretty close as we speak to those sort of numbers. And that may be what the driver is. Now, this is an important sea change in terms of how financial markets work, because everyone has been thinking, probably up to now, that it's the London gold market, which is ever since the 19th century, was the main gold market in the world. That's where bullion is basically the price is set. But actually, maybe wrong. Maybe the price is being set in Shanghai now. The Shanghai Gold Exchange may be the important one. China's the world's biggest producer. They've been accumulating gold massively over the last few years. And, even in March, the PBOC, the People's Bank, was buying bullion again. So there's big appetite there. And if you look at the Shanghai Gold Exchange, it trades at a premium, a consistent premium to the London price. So what that's telling you is there's a constant bid from Asia. And that may be a key dynamic. Now, where gold prices go, commodity prices normally follow within about 6 months. So that would suggest you've also got to start looking at silver, look at copper, look at other associated metals.
Many interesting points there. The one thing I want to touch on, though, is if China is indeed selling bonds to purposely drive yields higher, and if they're doing it, I'm sure other countries are doing it too, because nobody wants to see their bond holdings go down. But how does the U.S. combat that?
Well, the trouble is, as I said right at the beginning, they've sort of lost control of the bond market. Now, the difficulty that the US faces is that the US traditionally was a price maker in bond markets. The US Treasury was the benchmark, and basically all other countries priced off that. But if you look at the data, really since 2020, there's clear evidence now that actually the US is a price taker in international bond markets, no longer a price maker. And that change, that sea change, pretty much coincides with the dropping away of China as a major buyer, the falling away of Japan. Japan's still buying, but nothing like in the size it was. And you've got other governments who are, broadly speaking, sitting on their hands. They're not accumulating treasuries in the way they were. So what we're left with now is a Federal Reserve which could buy, but certainly at the moment isn't buying, and a sort of coterie of hedge funds who are supplying most of the marginal buying in the market through the so-called basis trade. And that's a sort of perilous place for Scott Bessent to be, if he wants to raise money in the treasury market. Now, if you've got 30% of your debt you've got to roll over and refinance, it matters critically what the interest rate is right now. And, if you go back to the math of the interest bill, I mean, against a marketable pool of treasury debt of about, I mean, the bigger figure you said, 35, 36 trillion, is all US debt, but the marketable bit is about 28, 29 trillion. And if you said, well, okay, a trillion of that is interest expense, what you're talking about is probably an average interest rate of about 3%. Now, clearly, that's not the interest rate in the market right now. The interest rate in the market is nearer 4.5%. So every time that Scott Bessent refinances, he's pushing the average interest rate bill up. And that means that the trillion goes to 1.25 trillion to 1.5 trillion to 1.75 to 2. You get the point. That bill starts to escalate. And that's something which is only adding to the debt pile. So, you're basically running hard just to stand still here. And that's really the big dilemma. So I think that it's not an easy process. Now, there is a way out, but that way out is not in itself a particularly convenient or happy way out. And the happy way out, or the way that they could do it, or less happy way out, but the way they could do it, is they could force Jay Powell to actually slash interest rates, and they could try and get interest rates down. Whether they get rates down across the curve is a moot point. I would rather think that if they cut rates, rather like what happened last fall, if they cut rates, actually the long end sells off. It doesn't rally, so that's a risk that they're going to run. But it would basically mean that they fund more at the front end. And the other option is actually directly to go in and fund at the front end, do what Janet Yellen did. Now, Janet Yellen didn't leave Scott Bessent a great legacy because, as we know, she was funding 60% of the US deficit through bills and short-dated bonds from 2022 onwards. So there was a whopping great skew towards the short end. But she did that opportunistically. Scott Bessent has said he doesn't want to do that anymore. I mean, that's noble intentions, but he may have no choice. So if he goes down this route of funding at the short end, that is what is called monetization, simply because the big buyers of short-dated debt and bills are the banks. And if the banks buy treasury debt, they are monetizing the deficit. And we know that doesn't end well.
And you mentioned that the current interest rate on the government debt is the average is 3%, but the 10 years trading around 4.5. I mean, do you see the risk of this interest rate or the yield going significantly higher? Like maybe investors say, you know what, 4.5 is not good enough. We want 5%. We want 5.5%. Do you see that happening? And if so, do you think it happens this year?
Well, it's certainly possible. I mean, that's for sure. I mean, the backdrop one's got to remember is that Scott Bessent's trying to do this funding at a time when a lot of others are doing funding. You've got in Japan inflation really starting to accelerate now. So the yield on the JGB has picked up from virtually fractions of a percent to over 2% now. So that's a big change, certainly percentage wise in the case of Japan. Then you've got Germany, which has now released the debt brake because it needs to do a lot more spending both on infrastructure and on more particularly defense. So you've got a lot of euro debt which is going to be coming to the market. And then you've got China, who must in some way dig itself out of this tariff tremor. And the only way it can really do that is by domestic fiscal policy. So they're going to be issuing a lot of debt. And so what you've got is the world economy is going to be saddled with huge issuance. Now, that must only push prices down. So what you've got is yields backing up because of that. And that's going to make it an uncomfortable backdrop for Scott Bessent. Now, the caveat in all that is that one assumes that the economy doesn't go into recession, but we think it is going towards recession. So it may well be that he sort of gets out of jail by the fact that a recession forces people back into the bond market. And that's maybe the way out. But the picture I'm painting is not a great one for the stock market. Recession they don't like, high yields they don't like, too much funding they don't like. So this is a period where it's going to be a lot tougher as we foreshadow. 2025 is not likely to be a great year for stocks. The best we can hope for is a sort of sideways ranging market.
I want to ask you one more question about China. And China's been preparing for this trade war since 2018. And at that time, I believe 18 to 20% of their exports were going to the US. Now it's down to 12 to 14%. So the US is becoming less and less important to China. And at the same time, they're increasing their exports to other countries. And now they're running a trade surplus over $1 trillion a year. No other country has ever done that. They're selling goods to South America, Africa, the Middle East, other countries in Asia. And I guess my question to you is the US still important to China? And is China important to the US? Like, where do you think this relationship goes?
Well, I think the if we sort of get to the end game first and then work back, I think the end game is that there has to be a combination between both sides. I mean, these two economies are too big, too important, too integrated to basically separate entirely. So I think it's unrealistic to suggest they would. There's got to be a deal, to use Trump's terminology. There has to be, simply. Whether that deal is, the agreement that China limits its exports, whether it agrees not to do stealing of technology, whether it agrees to build factories in the US. I don't know what shape it takes, but it's got to take some form. And I think that is inevitable at some stage. That may not happen overnight. It may take years to follow through, but that's the direction I think things are going in. In terms of what happens in the interim, I think that America is probably under these sort of trade negotiations is in a stronger position than maybe many think, for the simple reason that if you think of deficits as a little bit like squeezing a balloon. So, if China reduces its deficit with the US, it's going to increase it somewhere else. But then those other countries are going to be having to accommodate China, and they might not want to. And then you've got also the added risk that it's possible that that they will re-export, or China will re-export through those countries. I mean, Vietnam being a very good example of a backdoor exporter of Chinese goods to the US. So I think we've got to be cognizant of these general risks. But China is not in a great position, one would have to say, given everything that has been said and known so far. And I think you can embellish that further by saying there could well be an innovative deal, who knows, whereby as part of these trade deals with the so-called the 75, whoever they may be, who have approached the White House in the last 2 weeks to do deals, part of that, the subprint may be that America agrees some sort of security umbrella for these countries as well, in return for their commitment to keep using the dollar and to keep investing in US Treasuries. Now, although these countries are likely small, if you add them together, it could be quite a sizable amount. And I think that would give some security to investors in the Treasury market. So there are things that can be done. But I think ultimately what I would say, which comes back to the very first point, is that the US may win the trade war, but it's got to make sure it wins the capital war. And that's not easy because they seem as if they're losing control of the fixed income markets now.
And so I want to ask you about the US dollar now, because this is also being reflected or being impacted by what's happening in the bond markets. But in 2024, the USD was up 7% as measured by the DXY index. Now it's down 7%. The index is below 100. Where do you think the US dollar is going? Does it continue to fall?
Well, I think the answer is against what? So let's get. This is always the hardest question when looking at forex markets is against what? And I think the what I would say, I've got absolute conviction that the gold price goes up. So that keeps going. So the US dollar devalues, the paper dollar devalues against gold. Fair enough. Okay, we may all come quietly on that. I think against the other major units, it's really a question of some doubt or maybe uncertainty. I mean, I don't think the conditions are there right now to say that the US dollar is in a crisis zone or anything like that for a currency. I mean, there's been a lot of stuff, a lot of ink spilt in the last week or so to say that this is an emerging market currency and the US dollar is toast and whatever. I mean, it is ridiculous. It's nothing like that. I mean, we're basically back to levels of the dollar, if I'm correct, probably a little bit before the election. I mean, depending which currency you're looking at. But I mean, the dollar pushed up a lot in that space and it's come back. And the dollar has given up really because of two things, in my view. One is the Federal Reserve is easier, but that's a technical factor because of the drawdown of the TGA, the Treasury General Account, during the period of the debt ceiling. The Federal Reserve is forced to pump liquidity into the system just by dint of how you fund the government. And so the easing of liquidity is negative for the currency. So that's one thing. And the other is that the US economy is slowing down quite fast on all the indications that we look at. And that would be another factor why the dollar should give up. And if you look at the models projecting what the dollar should do, there's nothing untoward or unusual about this weakness in the dollar given those two factors. So I don't think the dollar is in a crisis zone. Then you come to the question about what about capital flows? The capital flows exiting. Well, I don't see that either. And I think if you take a broader perspective and you say, well, okay, what are the preconditions for will all this make it, maybe put it a different way? Would all these tariff barriers, etc., change the US deficit? No, because economists know that deficits are all about savings investment imbalances, not about really about trade competitiveness. So unless there's some change in the dynamics of the US economy, the trade deficit's not going to change. And by definition, the capital flow background is not going to change. So there's no evidence, put it another way, that capital flows are leaving en masse the US economy. Now, it may be that certain elements are, for sure. It may be that investors are selling their stocks and some are selling their treasury securities. But I don't think there's a mass fall. And I think one would have to say that if Trump is successful in this trade war battle, then you can see a lot of investment going into the US in terms of FDI, foreign direct investment. That is the end game, and that I can't see why that should be why that's such an impossible ask. It seems to me that's quite feasible. So that's all well and good. But the question at the end of the day is, are they in a situation where they can really win the capital war? And that's really about maintaining the integrity of the treasury market. And it's very difficult to maintain the integrity of the treasury market when you've kind of lost control of it in the way that's recently happened. You haven't got foreign buying. I mean, remember back in, what was it, 1999, 2000, 40% of the treasury market was owned by foreigners. And these are big, big numbers. It's down to whatever the figure now, it's sub 20%. So there's been very dramatic changes in the supply and demand dynamics in the treasury market anyway. So I think that is what needs to change, basically. There needs to be some forward thinking about how they maintain the integrity of treasuries. And that may be some combination of Doge, that may be some combination of trying to do yield curve control. But it's not an easy task.
Sorry, what year did you say foreign investors owned 40% of US
I think
Treasury?
that was year 2000, 1999, 2000.
Oh, well, so it's been a slow, constant erosion over the
Yeah,
last 25 years. Okay.
yeah.
Now, I want to ask you about the US financial markets, and the volatility we've seen in the last few weeks has been historical. And in one 3-day period, we lost $10 trillion in market value. And the NASDAQ was up 12% in one day alone, the second largest update we've seen since January of 2000. The S&P was at one point down 18% from its highs. Now it's only down about 8% on the year. But what's your take on the S&P? You mentioned earlier that you think it's still going to be under pressure, but do you think we have to buy these pullbacks or do we sell the rallies?
Well, let me let me put this in terms of the way that I think about markets. What you've got is you've got two inputs into asset prices. One is the flow of money that comes into a market, and the second is the deployment of that money in terms of risk assets. Well, let's look at the second thing first of all, the deployment of money into risk assets. What you've seen in the last actually the last 4 or 5 months, really since the election, you've seen a tremendous pullback in terms of risk positioning of US investors in a way that we probably only last saw during the COVID crisis or before that, looking at 2007, 2008, the global financial crisis. So there's definitely been a big risk off move that actually hasn't been mirrored to the same extent in the rest of the world. So US investors have basically been spooked, maybe not surprisingly, by what's going on. Now, if you put this into context, their risk off behavior, their risk off positioning has only been bettered or worsened, if you like. There's a more risk off situation only 8.5% of all occasions since 1978. So that puts it into context. We're in a very unusual situation here. Investors are very risk off, and they've only been more risk off 8.5% of the time. So that would suggest that from a long-term standpoint, there's not a bad buying opportunity. Now, that long-term view is probably saying, let's take an 18-month view. And that's normally when you see those sort of reactions occur. So this is kind of Warren Buffett time, right? Be greedy when others are cautious and be cautious when others are greedy. And that's a time when, he could well be in the next few weeks buying more assets. Who knows? But it's that sort of time. The other input is then looking at the flow of liquidity into the market. And that is why I'm a lot more uncertain for a number of reasons. The main reason is basically the Federal Reserve. And the Federal Reserve is not really coming up and telling us what it plans to do with its balance sheet. And that's really the critical element. The Fed is being very, very coy at a time when it shouldn't be. The volatility you're seeing in the bond market, so for example, the MOVE index, The volatility you're seeing in the repo market, so for example, the SOFR less Fed funds spread, this volatility is symptomatic of a loss of liquidity. And the Federal Reserve has got to be there to basically add support to the market. This is what they're there for. And the head of the Boston Fed said on Friday that the Fed will come into the market if they see a liquidity event. Now that's reassuring. However, that's after the event, not before it. They should be there guiding the markets and making sure you don't get these potential systemic problems. And I think all the evidence is pointing to the fact that you've got a lack of liquidity within the system right now, and it's kind of precarious. And I think that's the sort of, you don't want this bad news as well during a time of great uncertainty. So I think the Fed has to come clean and say, we're going to at least stop QT now, and we're going to start injecting liquidity back into the markets to actually give some support. You might not want to call that QE, or that probably is. You want to call it something else like QS. So the acronym department of the Federal Reserve has got to think up a new name, which maybe they're pondering on right now. But that's the way it's got to go. I mean, the fact is that in a debt-dominated world, which we're in, where capital markets are all about debt refinancing, you need balance sheet capacity, you need liquidity, and that's what the Federal Reserve actually controls at the end of the day. And they can't sit on their hands and say, well, we're not doing it, for whatever reason.
And it's very unusual to see the stock market, the bond market, and the US dollar all down at the same time. Do you think this is a referendum on the US? Is this the world casting their vote on the US?
No, I think that I think, Jimmy, you could say exactly the same thing on the other way. If you look at the last 3 months of last year, all those factors were up. Bonds were rising, stocks were going up, the dollar was going up. There was a lot of money coming into the US. And I think what this is telling us is that there is money coming out. I think what I'm disagreeing with is the consensual view that says this is a sea change. It's the end of US exceptionalism. The US dollar is toast, end of story. This is not the case. The US is still one of the dominant economy worldwide. It stands up really well against Japan and Eurozone, and those are really the competitor currencies. So I think one's got to be realistic here. Is Wall Street going to go up this year? Well, I think my view is I think it's at best range bound. I think that's what I would suggest. If you've got a recession, then there's another issue to face. I think there probably will be a recession, but the hidden uncertainty in a recession is what the credit markets do. And I think that if you look coming into this crisis, what was going on in credit, I didn't think it was a great looking picture. You had 5-year single B US corporate credits trading through 30-year mortgage-backed securities. Now that's never happened before. Mortgage-backed securities is a government-guaranteed bond, although it's got longer duration. You still have never seen the 5-year corporate bond single B trade through that, and that was telling you that corporate credit was way mispriced. That's got credit risk the mortgage-backed security hasn't, and so basically the market had got ahead of itself. And I think that's all to do with the fact that there's been very little corporate issuance of late. That's because a lot of debt was termed out during the COVID crisis back into 26, 27, 28. Problem is that's coming up for renewal, ahead of us. And so this debt maturity wall is now coming at a time when rates are, a lot higher than they were 5 years ago. So the problems can compound.
Okay, you mentioned recession a couple of times, so let's discuss that. I recently saw an interview with Ray Dalio, and he said the U.S. is on the brink of a recession and possibly something much worse. He didn't say depression, but he was alluding to that. What are your thoughts? Does the U.S. head into recession this year?
I think the odds are very high that's going to happen. I think the reason for that would be that number one, you've got to recognise that last year was an exceptional year for the U.S. economy because it was being stimulated not just by fiscal spending, but also by this sort of hidden easing by the Federal Reserve and by further hidden easing by Janet Yellen, because she termed out she funded the U.S. government at the short end of the market. Now, if you're doing a lot of funding through bills rather than long-dated debt, that's actually a liquidity provision for the economy, because actually treasury bills are really liquid and the banks tend to buy them. And as I said, that's effectively monetization. So that was a hidden stimulus. And on top of that, you had the Federal Reserve injecting money into the markets because of the rundown of the TGA and the reverse repo facility. So all these factors were stimulating the economy last year, and they're not stimulating the economy now. They're spent. So the economy is anyway going to slow down, and that's what we've been saying since the end of last year. Watch out for a major slowdown in the US economy because these sort of hidden or surreptitious sous la table stimuli are basically disappearing. Now you've got that slowdown on top of the trade bomb that Trump has exploded, and that clearly is not going to be good as well. So I think you have got the likelihood of a recession. That may not be priced into the stock market yet. Difficult to say, but that's one of the dangers. Now there would be a potential feedback on liquidity there that is unknown because an awful lot of collateral that backs up the liquidity story is actually based on corporate credit. So if you start to undermine corporate credit, if corporate credit sours, then you're going to see a situation where there's a negative feedback, liquidity gets crimped, and there's a further second link down in markets. And that's clearly a risk one's got to be cognizant of. But it's very difficult to predict that without knowing A, there's going to be a recession and how bad the credit mess really is. But clearly, we've got to be alert to it.
And you and your team at CrossBorder Capital focus on liquidity trends and flows for 90 different economies. And because of the disruption that we're seeing with these potential trade wars, I'm curious what your research is showing about liquidity flows throughout the global economy.
Well, the answer is okay. The short answer is that if you look generally around the world, liquidity is holding up quite well. I'm not going to say it's going gangbuster, but it's actually holding up pretty well. The reason that it's holding up is largely for three reasons. One is the dollar has come off, so that's actually positive for liquidity generally because it encourages more dollar borrowing, etc. The second reason is that you've got the US, which has been easing, as I say, maybe temporarily and maybe technically, for the simple reason that the debt ceiling has forced the Federal Reserve to inject funds into the market. And then you've got a third thing is that China has actually injected quite a lot of liquidity. In the last 3 months, taking seasonally adjusted or trend adjusted figures, what you've got is about 4.5 trillion yuan being injected into the system by the Chinese People's Bank. And that's a significant amount of money. So they are, they're definitively changing. And I think that, their response to the tariff bomb or trade bomb is that they're going to stimulate their economy. And they haven't been doing that for a long, long time. They've been trying to keep the yuan stable against the US dollar. So I think there's a change in China. So generally speaking, that should be pretty good looking forward, certainly for commodity markets, and as I alluded to right at the beginning, for gold as well. But generally, that's the picture. Others are not easing yet, or if they are easing, it's minor stuff. So the Central Bank of Singapore, the monetary authority, eased today, but that's small scale. But you can see generally with a weaker dollar, more scope for easing than not. But again, we'd like to see the evidence of that. I think the issue that one's got to think about is this equivalent to a 2007, 2008, or a 2020 COVID crisis? And I think the differences is there's a lot less fiscal space around for governments to ease policy this time around because deficits are fatter, certainly in the US, and you've also got debt GDP ratios which are sky high relative to history. So it makes it very difficult for them to actually ease through fiscal policy, which means that it may be the monetary authorities that are called on to slash rates. The problem is that compounds the problem because lower interest rates stimulate debt, so it pushes the problem off further into the future. But that may be an option. But I can't believe that policymakers are going to stand by and do nothing here. They've got to do something, particularly if economies dip down. And I think you're going to see the first evidence of that really in the next quarter.
You mentioned earlier that in this environment, you're bullish on commodities. You said your target price on gold is 3,500. It's currently around 3,200. You also mentioned copper, silver. Any other commodities? What about oil?
Well, oil is one I'd probably make an exception to because I think that oil is to a very large extent political these days, and I think that there is, that I mean, I'm not going to say that I understand the geopolitics, but I think there's a lot of attempts, certainly by the administration, to actually get the oil price down and keep it there. And so I would be surprised if you get a much stronger oil price. But it may well be that if China does stimulate its economy hard, that's what happens. But I would tend to think, a slower US economy is going to at least keep a cap on that. I mean, the advantage of China stimulating and maybe that feeding through to Asia is that Asia is a buyer certainly of precious metals and it's a big user of things like copper. So some of those industrial metals may get more of a bid, even though the US economy weakens. But broadly, as I said, if you see the gold market stronger, it's typically the case that you see other commodities picking up within about 6 months of that. And that's really what we expect. So we think that those markets will be firm for sure.
And do you have a target price for silver?
No, I haven't really got a target price for gold because I still think the gold is going to keep going up. What I said was that the Chinese need to get the yuan gold price above 26,000. So it may be that they get to 30,000. But I think the gold is going up because basically, at the end of the day, look, we're in such a mess with all this debt. The only way you get out of debt in the long run is to monetize. And I think the very simple fact that everyone ought to recognize is that in year 2000, or compared with now, US debt has gone up 10 times since year 2000, right? Tenfold increase in the stock of US debt. How much has the gold price gone up? The answer is it's gone up almost 10 times. So gold has been an absolutely perfect monetary inflation hedge. And if you're increasing the amount of treasuries in the system, this by definition you're effectively monetizing because this is a core collateral asset. So if you think the debt is going to stay still here and not increase, and deficits are going to disappear, and governments are going to, sort of wither on the vine, I'll come quietly and say, well, the gold price doesn't go up. But I don't think that's the reality. The reality is that politicians want to kick the can down the road. They're not. It's not in their interest to stop spending, and most Western societies are overtaxed anyway. So the only thing they can do is basically, try and fund through the bond market. And if that's difficult, as we tried to allude to, they're going to have to monetize, print money. That's the easy way out. But politicians often take the easy way out. And if that's the case, you've got to find monetary inflation hedges. And that's why gold, I think, is an integral part of portfolios and why Bitcoin probably also is.
So let me ask you about that because Bitcoin is, in my opinion, it's a risk asset, no different than trading the NASDAQ 100 or whatever. Are you bullish on Bitcoin here? It's pulled back. I think it got up to 110. Now we're trading at, where is it? The low
80.
80s?
Yep. Well, the answer is in the long term, Jimmy. I am. Yes, I think Bitcoin probably will be. I mean, without being an expert on cryptocurrency, I mean, the fact is you've got an asset with a fixed supply. And the history of the last 10 years has shown that it's been a very good monetary inflation hedge and it's extremely sensitive to liquidity. I mean, there are charts in the pack I'll send you, which you can display, which basically show that sensitivity. But one of the things that really stands out in terms of the factors that drive Bitcoin is you've really got three factors which are driving the price of Bitcoin, or at least three systematic factors. One is liquidity, which accounts for probably about 40-ish% of the movements in Bitcoin. Then you've got another element, which is the gold price, which has a big effect. But it's not always a positive factor, but it's complex, but gold is in there. And then the other factor is actually risk appetite, as you rightly say. Now, risk appetite can be best benchmarked against NASDAQ. So, I agree with you on that. So if NASDAQ sells off hugely, what's Bitcoin going to do? It's going to follow. If NASDAQ goes up hugely, what's Bitcoin going to do? It's going to follow and go up. So you've got that risk appetite or risk element in Bitcoin that you don't have in gold. Gold is almost purely a liquidity phenomenon. Gold is a risk appetite. Sorry, Bitcoin is a risk appetite and a liquidity phenomenon. So if you had all the ducks in a line, you had gold going up, risk appetite improving, and liquidity going up, Bitcoin is wonderful. But if you have two out of three of those going down, or worse, all three going down, Bitcoin's not going to perform well. And I think that what you've seen in the last 3 months is actually evidence of that fact. It's been hit mostly by the big sell-off in the US market. And as the market's rebounded, so has Bitcoin. But the background is that liquidity isn't too bad at the moment. It's other factors that are going on.
Michael, I want to ask you about a potential black swan event. And you have said in the past that all financial disasters are brought on by an inability to refinance debt. And we might be in that situation right now. But do you see this as a potential black swan event? The US government is not able to refinance their debt?
Well,
And
The
maybe a
government
lot of
will
corporations too.
well, the government will always be able to refinance its debt. The question is what price? Well, are they going to do it at a decent price? And I think the thing is that the problem is that yields they've lost control of the long end of the market. They need to get that back. Now you're right to say that perhaps Scott Bessent will welcome a recession in that regard because it would help him. It would be a discipline. The problem you've got with a recession, which makes this even more complicated, is that in past recessions the deficit has added about 4 percentage points of GDP. So it's a little bit like trying to hold on to a bar of soap in a shower. I mean, the more that you squeeze, the more this thing runs away. And that's a difficulty. So I think that he's not given an easy task. And that's why I think that inevitably what's going to happen is that the path of least resistance is the fund at the short end of the market because he can control interest rates if he puts enough pressure on Jay Powell. And that would basically keep his interest rate cost down in the short term. And that would leave scope to maybe try and convince bond investors that the US is disciplined. He's got another 3 years to do that, so that may be an option. But I think it's a very tricky situation. What is the disaster out there? The black swan, in my view, I mean, we never really know what a black swan is, I suppose, but my view, the potential black swan is the Federal Reserve again. And so often the Federal Reserve has said, as it said ahead of the global financial crisis in 2007, oh, well, the housing market's not a problem. Bernanke was on record as saying that. I think that was in 2006. And clearly it was. So the Federal Reserve, I mean, my sort of mentor at Salomon Brothers was Henry Kaufman, and Henry always used to say through his experience with the 60s, 70s, 80s, he said the Fed is always behind the curve. Financial innovation in markets way outstrips what the Federal Reserve can do. So they're always basically late to the party here. And the problem is that they have good words to say. Okay, as I said earlier on, head of the Boston Fed said, well, if we get trouble here, the Fed's going to act and put liquidity in. Yeah, okay, great, but they should be doing that ahead of the event. They should be making sure markets are liquid. And I know all the moral hazard questions about you shouldn't do that, but that's the reality of the world we live in. We live in a world of massive debt, unfortunately, but you've got to accommodate that. You've got to recognize the facts, be realistic.
And Michael, if you assume that the Fed is acting independently and it's an independent agent separate from the government, how can Besant control what the Fed does, or how can they encourage him to cut interest rates?
Well, I think there is a history of the Fed and the Treasury working together at different times. I mean, one there was actually official cooperation. There hasn't been, I think, since 1951. There've been more independent entities, but I would say it's probably wise counsel on both behalves would actually say that this has to be done because otherwise there'll be a big problem for the U.S. government. I mean, at some stage, I mean, what we know from experience is that at some stage, heads get knocked together and they say, well, okay, we need to fund the deficit. We've got to, smooth funding conditions in U.S. markets, and it's in very much in everyone's interest that the Federal Reserve comes here and supports what the Treasury is doing. So, at the end of the day, what the remit of the Fed is, regardless of what is said, in whatever act, job of the Fed is to preserve the integrity of the sovereign debt market, which is the US Treasury market. That's what they're there for ultimately, and that's what they've got to do. And if push comes to shove, that's what they will do. And we've seen that in many occasions, not just in the US, but worldwide. Look at the alacrity with which the Bank of England switched from a QT policy to a QE policy overnight during the Liz Truss debacle when the bond market needed support. They didn't flinch, they just did it.
Jay
Same can happen
Powell,
again. But
Jay Powell still has 1 year left in his term. Do you think he survives the next year?
well, I think it would be. I think. Well, in actual fact, he has 1 year left as he's still on the board, but I think he has 1 year left as chair. So he's still a voice in the Fed. Will he be the chair in a year's time? I think the odds are no, but never say never, of course. And I think that Trump clearly would want him out. I don't think that's necessarily a great look for the markets. But at the end of the day, I mean, one would think that, as I said, wise counsel will come through here, and I think Scott Bessent is a as a wise head, and he will probably say to calm everybody else and say, look, it's in everyone's interest here not to get too overheated. And at the end of the day, the Federal Reserve has to ease this year. They have to expand liquidity. The question is, we know what they've got to do. It's a question of getting there without a loss of face, and that's probably the issue. But I think Scott Bessent is. I'm sure he's onto the case.
He certainly has his hands full. Well, Michael, that was a great discussion as always, and I want to thank you very much for making the time. If somebody would like to learn more about you and about CrossBorder Capital and read your research, where can they go?
Best way is Capital Wars on Substack. We write that pretty frequently, every 2-3 days as a piece. Alternatively, you want an institutional service, that's crossbordercapital.com, and we provide data and narrative research.
And you're also very active on Twitter. What's your handle?
Oh yeah, Twitter. Sorry, the Twitter handle is at CrossBorderCap. We provide tweets occasionally on Twitter on different aspects.
Michael, once again, thank you.
Great pleasure, Jimmy. Thank you.